Ever wondered how the biggest companies, the giants, actually account for all their wheeling and dealing?
It's a good question.
Yeah, I mean, everything from buying just a tiny sliver of another company to, well, taking over an entire business empire.
Right. It can seem pretty opaque from the outside.
Totally opaque. But trust me, once you understand just a few key concepts, you'll unlock a whole new level of financial insight. It's actually fascinating.
It really is. The headlines might grab you with the size of a merger or acquisition, right?
Yeah, the big numbers.
But how those investments actually get recorded on the balance sheet,
Mm.
that truly defines a company's reported financial health, its strategy even.
It's way more than just a simple purchase receipt then.
Oh, absolutely.
Yeah.
Far more complex.
Exactly. And that's really our mission today. We're taking a deep dive into investments, from individual securities to consolidated giants.
Mm.
Our goal is to simplify this complex world, pull out the most important insights, maybe share some surprising facts.
Yeah, the fun stuff.
Right. All to make you truly well-informed, but, without feeling totally overwhelmed.
Think of it like getting X-ray vision for financial statements.
I like that analogy.
By the end of this deep dive, you'll be able to look at a company's reports and sort of intuitively grasp the true nature of its investments. It gives you a powerful shortcut,
A shortcut to being financially astute. Love it.
pretty much.
Okay, let's unpack this then. Let's start right at the very foundation. What exactly are financial instruments anyway? Sounds a bit, I don't know, technical.
It can sound that way.
Okay.
But at their core, financial instruments are, well, they're simply a broad category. Items that represent a monetary claim or a monetary obligation.
Okay. Claim or obligation.
Yeah, the basic building blocks. We're talking about both financial assets, things you own that could bring you money later, and financial liabilities, basically debts you owe.
Got it. Assets and liabilities.
So on the asset side, think simple things first.
Yeah.
Cash in your bank, maybe foreign currency you hold. But it also includes proof of ownership, like stock certificates that show you own a piece of a company or maybe partnership interests.
Right, owning stuff.
And beyond that, direct ownership, financial assets also cover contracts giving you a right to receive cash or another financial instrument later.
Ah, like bonds.
Exactly. Bond investments are a perfect example. They promise you future payments or notes receivable where someone owes you money.
Okay.
And here's where it gets maybe a bit more dynamic.
Yeah.
They also include contracts giving you the right to exchange other financial instruments on terms that are potentially favorable to you.
Like options.
Precisely. Stock options, futures contracts, other derivatives. Things that let you buy or sell something at a certain price down the road.
Okay, that makes sense for assets. What about the other side? Liabilities.
Right. If we flip that coin, financial liabilities are contracts that impose an obligation.
An obligation to pay.
Essentially, yeah. An obligation to deliver cash or another financial instrument. So bond obligations where you owe money or notes payable. And just like with assets, they can also be contracts that obligate you to exchange other financial instruments on potentially unfavorable terms. Again, think certain types of options or derivatives, but now from the side of potentially having to give something up or pay more.
This is a really critical distinction right off the bat, isn't it? Because I know companies have a strategic choice with some of these instruments. It's called the fair value option, right?
That's it, the FVO.
What does this option let companies do? And how does it really change what we, as readers of financial reports, actually see?
Well, the fair value option, or FVO, it's a pretty powerful accounting choice. It lets companies elect, they choose, to measure certain eligible financial instruments at their fair value.
Fair value meaning market price.
Yeah, current market price, even if the standard rules might say, oh, account for this differently.
Okay, so they can override the standard rules sometimes.
For eligible instruments, yes. And the biggest impact, the real kicker, is that any unrealized gains and losses.
Meaning the value changed, but they haven't sold it yet.
Exactly. Those changes in value get reported directly in earnings, net income.
Whoa. Okay, so why does that matter so much to us, to you reading the statements?
Well, it means those swings in market value, the ups and downs,
Yeah.
directly hit the company's reported profit or loss for that period.
So earnings could jump around more.
They could, yeah. It can make earnings seem more volatile. But on the flip side, it can also make them more reflective of current market conditions for that specific investment.
And once they choose this FVO,
It's generally irrevocable. Once you pick it for an instrument, you stick with it.
okay, what kind of things are eligible? Can they do this for anything?
Not anything, no. But recognize financial assets and liabilities. For instance, a company could choose it for a bond investment that might normally be classified differently, maybe as available for sale.
Okay.
By choosing FEO, the value changes go straight to earnings. Or they could apply it to an equity investment that might otherwise use a method we'll talk about later, the equity method.
But not everything is eligible, you said.
Right. You can't use it for investments in subsidiaries you fully control and consolidate, or for things like pension assets or certain liabilities like bank deposits. There are specific exclusions.
Got it.
And there's one nuanced point, but it's important for the full picture.
Okay.
For financial liabilities that a company designates under FEO, the part of the fair value change that's due to the company's own credit risk.
Meaning whether the market thinks the company is more or less likely to pay its debts.
Exactly. That specific part of the value change actually gets recognized in a different spot. It goes into something called other comprehensive income, or OCI.
Okay, hold on. You just threw out other comprehensive income, OCI. Can you quickly break that down? What is that for someone who maybe hasn't lived in financial statements?
Sure. Good point. Think of OCI as, like a special holding pen, or maybe a temporary waiting room for certain gains or losses.
That's a waiting room.
Because they aren't quite realized yet through a sale, maybe, or they're not considered part of the company's core day-to-day operating profit. Things like certain foreign currency adjustments or, as we just mentioned, some fair value changes.
So it's real value change, but it doesn't hit the main profit number.
Exactly. It's still part of the total picture of a company's financial health. It affects overall equity, but it bypasses the immediate net income calculation.
Why do that?
It gives you the full scope of value changes without making that core profit number, the net income everyone focuses on, jump around too much because of, say, temporary market swings that aren't locked in.
Ah, okay. So it smooths out the main earnings number a bit.
In a way, yes. While still showing the total change somewhere else. It's essentially a bridge between net income and the total change in the owner's stake in the company, the equity.
That makes perfect sense. So this fair value option, it gives companies strategic choices that can really impact how stable or volatile their reported earnings look.
Precisely. It's like deciding if you want those market ups and downs to hit your public scorecard immediately, or maybe wait in that OCI holding pen for a bit, depending on the instrument and the rules.
Okay, let's dive even further then. We've set the stage with financial instruments generally. Now let's get specific with debt securities. What defines them? And why does the company's intent, what it plans to do with them, change the accounting so drastically?
Right. Intent is key here.
It feels like the company's telling a story about its plans for that investment through the accounting.
That's a great way to think about it.
Yeah.
So a debt security, fundamentally, is just proof that you've loaned money to someone else, another company, a government.
Like buying a bond.
A bond is the classic example, yes. Corporate bonds, government securities, commercial paper, these are all debt securities.
And what are they not?
Good question. They're not things like stock options or futures contracts or just simple accounts receivable from your customers selling them goods. Those fall into different categories.
Okay, so once a company buys a bond, say, how does this story, this intent, play out?
Well, this intent is the primary driver for how that debt security gets classified. And that classification dictates the accounting. It puts the security into one of three main buckets.
3 buckets. Okay, what are they?
First, trading securities. Think speed? These are bought with the clear plan to sell them very, very soon.
Flipping them.
Exactly. Trying to profit from quick price changes, short-term differences. They're like hot potatoes. The company wants to move fast.
Yeah.
So they're usually shown as current assets on the balance sheet.
Okay, trading. Got it. What's bucket 2?
Second is available for sale, usually called AFS debt securities. This is kind of the default bucket.
Default.
Yeah, if a debt security isn't clearly trading, and it's not the third type, which we'll get to, then it lands here in AFS.
So the intent isn't necessarily to sell immediately.
Right. The company might sell these, maybe not.
Yeah.
There's no immediate firm plan to unload them quickly, like with trading. Their classification as current or non-current on the balance sheet just depends on how long the company generally expects to hold on to them.
Okay, AFS is the maybe sell category. What's the third bucket?
The third one is held to maturity, or HTM, debt securities. For these, the company must have the positive intent and, importantly, the ability to hold that bond, that security, all the way until it matures.
Until the very end date, when they get the principal back.
Exactly. They plan to collect all the promised principal and interest payments along the way.
What if they just might hold it to maturity? Or hope to?
Doesn't count. If the intent is just to hold for an indefinite period, but not necessarily to maturity, it falls back into AFS. Also a crucial point. If the company thinks it might not recover substantially all of its investment, maybe the issuer is shaky, then HTM classification can't be used either.
Got it. So HTM is only for the truly committed holders. How are they shown on the balance sheet?
Like AFS, they're classified as current or non-current, but it's based purely on the time remaining until maturity. If it matures within a year, it's current, otherwise non-current.
This intention distinction is so critical then. It really drives everything. But how does that intent ripple through to the numbers? How are these valued? How do gains and losses show up? It sounds like two identical bonds could look completely different on the financials.
You've absolutely nailed the core point. The classification dictates the valuation and the income statement impact. It's huge.
Okay, break it down for us. How does valuation work for each bucket?
All right. For debt securities reported at fair value, which includes both trading and AFS, the name tells you, they're valued at fair value, meaning current market price.
Okay, mark to market.
Exactly. Any ups and downs in that market price create what we call unrealized holding gains or losses. Still haven't sold it, but the value changed.
Right. Now, where do those unrealized gains and losses go? This is the key, right?
This is the absolute key difference between trading and AFS. For trading securities, those unrealized gains and losses, they are included directly in net income,
Straight to the bottom line.
straight to the bottom line. So they immediately impact the company's reported profit or loss for the period. It's very transparent about market moves, but as we said, it can make earnings look quite volatile.
Okay. And for AFS, the maybe sell ones.
For AFS debt securities, those unrealized gains and losses go into that special holding pen we discussed. Other comprehensive income, OCI.
Ah, the waiting room again.
Exactly. They bypass net income for the time being. So you still see the total value change affecting overall equity through OCI, but it doesn't make the core profit number jump around just because of market fluctuations that aren't necessarily tied to the company's main operations or haven't been locked in by a sale.
Huge difference. So trading hits net income, AFS hits OCI. What about the third bucket, HTM, the ones they swear they'll hold?
Right. Held to maturity HTM securities are different. They're reported at amortized cost.
Amortized cost.
Yeah.
What does that mean exactly?
It means you start with the original cost, and then you adjust it over time for the interest revenue earned, including the gradual accounting for any premium or discount paid at purchase. But, and this is crucial, it's without regard for current market value changes.
So they're not mark to market.
Correct. Unrealized gains and losses on HTM securities are not recognized at all in the financial statements. They ignore the market fluctuations because the intent is to hold to maturity and collect the contractual amounts, not to trade based on price swings.
Wow. Okay. So only realized gains and losses hit net income for HTM.
Well, realized gains and losses hit net income for all categories. That happens only when a debt security is actually sold. Or for an AFS debt security, if it's deemed impaired, part of that impairment can be realized in net income. But yes, all realized gains or losses land directly in net income.
That makes a massive difference in how you interpret the numbers. But this raises an important question. What happens if one of these investments just, well, goes south? If the borrower looks like they can't pay, how do we account for impairment?
Ah, yes, impairment. That's where the current expected credit losses model, usually called CECL, comes into play.
Okay.
Under this model, which applies to both AFS and HTM debt securities, companies have to look forward. They report these investments at the net amount expected to be collected.
Expected. So they have to estimate potential future losses.
Exactly. They have to proactively estimate how much they expect to lose due to credit risk borrowers not paying it all back. This estimate is based on current conditions, their past experience, and reasonable future expectations.
So you don't wait until the loss actually happens.
Nope. You recognize the expected loss up front. That credit loss is recorded as a current period expense on the income statement, and you create an offsetting allowance for credit losses on the balance sheet, which reduces the asset's carrying value.
Okay, so how does that work specifically for HTM, the held-to-maturity ones?
For impairment of held-to-maturity securities, if a company figures out it won't collect all the promised principal and interest, the investment gets written down. It's written down to the present value of the cash flows they now expect to collect.
Present value, so discounting those future expected payments back to today's value.
Precisely. The difference between this new, lower present value and the security's current amortized cost is the credit loss recognized. So if a $500,000 bond's expected future cash flows are now only worth, say, $473,000 in present value terms, the company recognizes a $27,000 credit loss expense and sets up a $27,000 allowance.
Got it. Now, is it different for AFS, the available for sale ones? You mentioned they could sell them.
It is different, yes, precisely because they have that option to sell. For impairment of the available for sale debt securities, the accounting is a bit more layered. The credit loss that gets reported in net income is limited.
Limited how?
It's limited to the amount by which the security's fair value is below its amortized cost. So you look at the market price decline first. However, if the total expected credit loss, calculated similarly to HTM, is less than that market decline, you only put the expected credit loss amount into net income.
And the rest of the market decline.
Any additional loss, meaning the fair value has dropped even further than the amount attributed to expected credit losses, that extra bit gets reported as an unrealized loss in other comprehensive income, OCI.
Ah, OCI again. So only the credit loss part hits net income and the extra market drop goes to the waiting room.
You got it. It tries to isolate the impact of credit deterioration on net income while keeping the broader market volatility separate in OCI until the security is sold or the situation changes.
Okay, let me try to summarize this debt part. The category, trading, AFS, or HTM, is driven purely by intent.
Primarily, yes.
That intent then dictates if it's valued at fair value or amortized cost.
Correct.
And crucially, where the unrealized gains and losses show up net income for trading, OCI for AFS, or not at all for HTM. And impairment under CECL means recognizing expected losses now, but the mechanics differ slightly between HTM and AFS, especially regarding what hits net income versus OCI for AFS.
You've laid it out perfectly. It's like those different financial swim lanes you mentioned, each with specific rules for how good news and bad news impact the bottom line and overall equity.
All right. Makes sense. Now let's pivot. We've talked about lending money, debt securities. Let's shift to actually owning a piece of a company. Equity securities. How does that change the game? We're moving from being a creditor to being an owner here.
That's a great way to frame it. An equity security fundamentally represents an ownership interest in a company, or sometimes the right to get or give up an ownership interest at specific prices.
So, common stock, preferred stock, that kind of thing.
Exactly. Your typical ownership shares. But it also includes things like stock warrants or call options that give you the right to buy shares, and put options that give you the right to sell shares.
Okay. What's not included here, just for clarity?
Good point. Things like preferred stock that must be redeemed by the issuer, or a company's own treasury stock it bought back, or convertible bonds, those are generally treated differently, often more like debt until converted.
Got it. So for these true equity stakes, how are they generally valued? What's the main rule?
The general rule for equity securities is simpler, in a way, than debt. They are typically carried at fair value through net income or FVT&I.
FET&I. So fair value, market price.
Right. And the NI part means any unrealized holding gains and losses, the value changes before you sell, are included directly in net income as they happen.
Ah. So just like trading debt securities, the market ups and downs hit the income statement directly.
Generally, yes. That's the default for most equity securities. So market volatility flows right through to reported earnings.
Is there an exception? What if you own stock in a small private company where there's no daily market price?
Exactly. There's a practicability exception. For equity investments that don't have a readily determinable fair value, like that small private company stock, or shares that just don't trade often, a company may choose to measure them differently.
Oh.
They can measure them at their original cost, less any impairment, plus or minus any observable price changes from identical or similar investments made by other investors. So, if someone else buys or sells shares in that same private company at a certain price, you might adjust your carrying value based on that transaction.
Okay, a practical alternative when market prices aren't available. Does everyone get to use this?
No, this exception isn't available for certain types of entities, like broker-dealers, investment companies, or employee benefit plans. They generally have to estimate fair value, even if it's difficult.
Right. Now, beyond just the market value changes hitting net income, how does a company record income from these ownership stakes? It's not just about selling them for a gain, is it? You get dividends.
That's a fantastic point. Dividends are a key part of the return.
But are all dividends treated the same way as income?
Not necessarily. A normal, non-liquidating dividend, basically, a distribution out of the investee company's current or past profits, retained earnings, That's straightforward. It's recognized as dividend income in the investor's net income, like getting interest.
Okay, standard dividend equals income. What's the catch?
The catch is the liquidating dividend. Here's where it gets, as you say, really interesting.
Liquidating dividend sounds serious.
It means the distribution you receive exceeds your share of the investee company's retained earnings. Think about it. They're paying you more than the profits they've accumulated that are attributable to your share.
So where's the extra money coming from?
It's essentially coming from the original capital. So from the investor's perspective, it's not income you earn from their ongoing profits. It's actually treated as a return of your original capital.
A return of capital, not a return on capital.
Precisely. So instead of being reported as income, a liquidating dividend decreases the investor's cost basis in the investment on their balance sheet.
Can you give a quick example?
Sure. Let's say you own 10% of XYZ Corp. XYZ pays out a $10 million dividend. You receive $1 million, 10% of $10, but maybe XYZ only had $8 million in total retained earnings when they declared it.
Okay.
Your share of those earnings is only $800,000, 10% of $8. So that $800,000 is recorded as dividend income on your books.
And the other $200,000 you received.
That extra $200,000 is the liquidating portion. It reduces the carrying amount of your investment in XYZ Corp on your balance sheet. It's like getting back part of your initial purchase price, not earning new profit.
That's a huge distinction for understanding a company's real income versus just cash received. Okay, what about impairment for those equity investments where you use the practicability exception, the ones without a market price? How do you know if they've lost value?
Good question. Since there's no readily available market price to check, impairment for those investments isn't triggered by daily market drops. Instead, a company looks for qualitative indicators.
Qualitative, like red flag.
Exactly. Red flags suggesting the value might be permanently reduced. Things like serious concerns about the investee company's ability to continue as a going concern, maybe significant negative changes in their industry or the broader economy that specifically hit them, a noticeable decline in their earnings, or even if someone makes an offer to buy that investment from you for significantly less than what you're carrying it at.
So judgment calls based on bad news.
A lot of judgment, yes. If these qualitative factors point towards an impairment, a decline that's likely other than temporary, then the investment's cost basis is written down to its estimated fair value. And that write-down amount is recognized as a realized loss directly in earnings.
Okay. And finally, just selling a regular equity security if you've been marking it to market through net income all along.
Right. If all those fair value changes were already hitting net income because you used FET&I, then the sale itself usually doesn't generate a significant new gain or loss at the point of sale. It's mostly been accounted for period by period.
Because the carrying value already reflects the market price just before sale.
Pretty much. If you use the cost method exception, then yes, you'd calculate a gain or loss based on the difference between the selling price and your adjusted cost basis at that time.
Got it. Okay, we've covered direct investments, debt, and equity where you're mostly a passive player or maybe just subject to market whims. But what if your ownership stake is bigger, enough to have a real say in how the other company is run?
Now we're moving into territory beyond just passive investing.
This isn't just about market value, it's about influence. And that brings us to the equity method. This sounds like it could get complicated.
It does add layers, definitely, but it aims to paint a much more economically realistic picture of that relationship. The equity method is used when an investor can exercise significant influence over the investee company.
Significant influence. What does that mean in practice? Is there a percentage threshold?
There's a common rule of thumb, a presumption. Generally, it's presumed you have significant influence if you own between 20% and 50% of the investee's voting stock.
20 to 50%.
Okay. But, and this is a really important point, it's not just about the percentage. The equity method might still be required even if your ownership is below 20%. If you can demonstrably exercise significant influence.
How would you show that below 20%?
Maybe you have a seat on their board of directors, perhaps you participate in their policy-making processes, maybe there are significant transactions between your company and theirs, or you share managers. It's about the ability to influence, not just the raw percentage.
So influence matters more than the number. Can it go the other way? Own 20, 50%, but not use the equity method?
Absolutely. Even if you're in that 20-50% range, the equity method is not appropriate if you genuinely lack the ability to exercise significant influence.
Like when?
Maybe the investee is in bankruptcy or reorganization, limiting your rights. Or perhaps you've signed a standstill agreement where you explicitly gave up certain rights. Or maybe another single investor or a small group holds the majority control, effectively overriding your influence despite your percentage. Or if you simply can't get the financial information you need from them.
So it really boils down to actual influence.
Exactly. Now, assuming you do have significant influence and use the equity method,
Mm.
how does it connect to the bigger picture? Well, it dramatically changes how both the investment balance on your balance sheet and the related income on your income statement are presented. It's a very different approach than just marking to market or counting dividends.
Okay, how does equity method accounting actually work then? Walk us through it.
All right. First, you initially record the investment at the price you paid to acquire it. Cost.
Simple enough start.
Then, from that point on, your investment account on your balance sheet gets adjusted continuously. It moves up and down to reflect changes in the investee's net assets, specifically your share of those changes.
How does it get adjusted?
Two main ways. First, your investment account increases by your proportionate share of the investee's net income.
So if they make money, your investment asset goes up.
Yes. And importantly, that same amount, your share of their net income, gets reported as income on your income statement, often on a line called something like equity and earnings of investee, or similar.
So you recognize income as they earn it, not just when they pay you a dividend.
Exactly. That's a
Okay.
fundamental difference.
Yeah.
You recognize your share of the economic gain as it happens. The second adjustment is for dividends. Your investment account decreases by the amount of cash dividends you receive from the investee,
Decreases. Why? I thought dividends were income.
not under the equity method.
Hmm.
Think about it. You already recognized your share of the income when the investee earned it. The dividend is just them giving you cash that, in theory, you already accounted for as yours. So the dividend is treated as a return of your investment, reducing your investment account balance.
Okay. That famous bank account analogy might help here.
It's perfect. Think
Yeah.
of your equity method investment like a bank account. Your share of the investee's earnings is like interest earned and deposited into that account. It increases your balance, the
Yeah.
investment, and its income when earned. And your share of the dividends they pay out is like making a withdrawal from that bank account. It reduces your account balance, the investment. But the withdrawal itself isn't new income. You already counted the interest when it was earned.
That makes it much clearer. Can we do a quick example?
Sure. Let's say Big Corp buys 40% of small company for $300,000. Assume this purchase price equals 40% of Smallco's book value, just to keep it simple for now.
Okay.
During the year, Smallco reports $90,000 in net income and pays out $40,000 in cash dividends.
Right.
So Big Corp's investment account would first increase by its share of the income, 40% of $90,000, which is $36,000.
Okay, investment up by 36K and income of 36K reported.
Correct. Then Big Corp receives its share of the dividends,
Mhm.
40% of $40,000, which is $16,000. This $16,000 decreases Big Corp's investment account.
Investment down by 16K, no income from the dividend itself.
Exactly. So at the end of the year, the investment account on Big Corp's balance sheet would show $320,000. $300,000 start, plus $36,000 income share, $16,000 dividend. And Big's income statement for the year would show that $36,000 as equity in subsidiary income.
So it's a very dynamic investment balance, constantly reflecting the investee's performance. But what if the price Big Corp paid, that $300,000, was higher than their 40% share of small companies' book value? That seems likely in the real world.
Very likely. And that's where it gets a bit more intricate. This difference between your purchase price and your share of the investee's net book value, NBV, needs to be accounted for.
How? Where does that excess price go?
It generally gets allocated to two things.
Okay.
First, asset fair value differences. Often the investee's assets, maybe buildings, equipment, patents, have a fair market value that's higher than what's recorded on their books, their book value. Part of the excess purchase price you paid is attributed to your share of this difference.
Okay, so I paid more because their stuff is worth more than their books say. What happens then?
That excess amount attributed to specific assets, like equipment with a 10-year life, for example, needs to be amortized or depreciated over the life of those assets.
Amortized, meaning expensed over time.
Yes. And this additional amortization or depreciation expense reduces the amount of income you report from the investee each year under the equity method.
Ah, so it lowers the equity and earnings number on my income statement.
Correct. Think of it like an extra depreciation charge related to your purchase premium. Using the bank account analogy, again, it's like a bank service charge related to that premium. It reduces both your investment asset balance over time and the net earnings you report from that investment. It prevents you from overstating your income by ignoring the fact you paid extra for those higher value assets.
Okay, that makes sense. What's the second thing the excess purchase price gets allocated to?
Anything left over after allocating to those identifiable asset fair value differences is considered goodwill.
Goodwill. The intangible value, brand, reputation, etc.
Exactly. It represents all those unidentifiable factors that made you willing to pay more than the fair value of their net tangible and identifiable intangible assets.
How is goodwill treated under the equity method? Do we amortize that too?
No. Under the equity method specifically, goodwill is not amortized. It just sits there as part of your total investment carrying value. And it's also not subject to a separate annual impairment test like goodwill in a full consolidation is.
No amortization, no separate tests, so it just stays there.
It stays as part of the investment balance. However, and this is important, the entire equity method investment, including the goodwill component, must be tested for impairment at least annually or whenever events suggest its value might have dropped.
Okay, so the whole investment gets tested. Let's talk about that. How does equity method impairment work?
An impairment loss is recognized under the equity method when two specific conditions are met. First, the fair value of the investment as a whole falls below its carrying value on your books.
Okay, market value is less than book value.
And second, crucially, the entity believes that this decline in value is other than temporary, meaning it's not just a short-term market blip, it's considered a more permanent reduction in value.
Other than temporary. So, a lasting decline. What happens if both are true?
If both conditions are met, then you recognize an impairment loss. The loss is reported on the income statement, hitting your earnings, and the investment's carrying value on the balance sheet is reduced down to its lower fair value.
Can you ever write it back up if the value recovers later?
That's a key detail under U.S. GAAP. For equity method investments, this impairment loss is not permitted to be reversed in subsequent periods, even if the fair value bounces back. Once you write it down for an other than temporary decline, that write-down is permanent.
Wow, okay. Once impaired, stays impaired on the books.
Pretty much, yes.
So what does this all mean for the equity method? It seems like it provides a really nuanced, almost living picture of the investment.
That's a perfect description. It reflects not just the direct financial transactions like dividends, but the ongoing economic performance of the investee and the impact of paying a premium, including how that premium gets accounted for over time through amortization, or sits there as goodwill until potential impairment. It's a much deeper look than just counting dividends or tracking daily market prices when you have that significant influence.
Right, it captures the economics of influence.
Yeah.
Okay, we've climbed the ladder from simple debt and equity up to investments with significant influence using the equity method. What's the final step? What happens when a company's stake is so large that it effectively controls the other company?
Now we reach the peak. Consolidated financial statements.
Consolidation. This is where we stop treating them as two separate companies in the reports. Right?
Exactly. This is where, for financial reporting purposes, we essentially combine them into one single economic entity.
When does this happen? Is it just the 50% mark?
Control is the key. And typically, control is established when an investor acquires more than 50% of the voting stock of an investee. That creates the parent-subsidiary relationship.
So over 50% usually means consolidation.
Usually, yes. Under U.S. GAAP, if you control a subsidiary, typically through majority ownership, you generally must consolidate it. There are very rare exceptions, maybe if the subsidiary is in legal reorganization or bankruptcy or under severe foreign restrictions that genuinely prevent the parent from exercising control. But the default is control equals consolidation.
Okay. Now, if the parent owns, say, 80%, what about the other 20%? Who owns that?
That brings us to a crucial concept in consolidation. Non-controlling interest, often abbreviated as NCI.
Non-controlling interest, okay.
NCI represents the portion of the subsidiary's equity, its net assets, that is not attributable to the parent company. So in your example, if the parent owns 80%, the remaining 20% owned by other shareholders is the non-controlling interest.
How is this NCI shown in the consolidated statements?
It's reported at its fair value at the time of the acquisition, and it appears in the equity section of the consolidated balance sheet. But importantly, it's shown separately from the parent company's own equity. It clearly signals that there's a part of this subsidiary's value that belongs to outside owners, even though the parent is in control and consolidating 100% of the assets and liabilities.
Got it. Part of equity, but separate. Now, what's the actual mechanism for combining them? You mentioned the acquisition method.
Yes, the acquisition method is the core accounting standard for these business combinations where control is obtained.
What are its defining features? How does it work?
It has two really distinct characteristics. First, 100% of the net assets of the acquired subsidiary are recorded at their fair value on the acquisition date.
100%, even if the parent only bought, say, 80%.
Yes, 100%. You measure the entire subsidiary at fair value. Any unallocated balance of the purchase consideration, including the fair value of the NCI, after assigning values to all identifiable assets and liabilities, creates goodwill.
Okay, 100% fair value. What's the second characteristic?
The second key thing is that when the companies are consolidated, the subsidiary's entire separate equity structure, its common stock, its additional paid-in capital, its retained earnings from before the acquisition, all of that is eliminated.
Eliminated. Wiped out.
Eliminated from the consolidated statements, yes. It's not reported separately anymore because the subsidiary is now viewed as part of the single consolidated entity. The consolidated equity will consist only of the parent's equity plus that non-controlling interest line item we just discussed.
Wow. Okay, so how does this happen in practice? Sounds like a lot of accounting adjustments.
It is. There's a series of consolidation elimination entries, often done in worksheets, that don't hit the actual books of either company, but are essential for creating the combined statements.
Can you give us the highlights? What gets adjusted?
Sure. You basically eliminate the subsidiary's pre-acquisition equity accounts, their stock, APIC, retained earnings. You also eliminate the investment in subsidiary account from the parent's balance sheet because you're replacing it with the actual assets and liabilities of the subsidiary.
Okay, investment account gone, subs old equity gone.
Right. Then you establish that non-controlling interest on the balance sheet at its fair value. You adjust all of the subsidiaries' identifiable assets and liabilities to their fair value as of the acquisition date again, the full 100% fair value adjustment.
Even the part the parent doesn't own gets adjusted to fair value.
Yes. Then you specifically record any identifiable intangible assets of the subsidiary, like patents, customer lists, trademarks, at their fair value, even if the subsidiary hadn't recorded them before.
Okay, and after all that?
After all that, you calculate goodwill. If the total consideration transferred, what the parent paid plus the fair value of the NCI, is more than the collective fair value of all those identifiable net assets you just recorded, the excess is goodwill.
And if it's less, if they got a bargain?
If the consideration is less than the fair value of the net assets, a rare bargain purchase, the difference is recognized immediately as a gain in the parent's earnings.
Okay, that's the initial consolidation. But what about transactions between the parent and subsidiary after they're consolidated? Say the parent sells inventory to the subsidiary. That's not really a sale to the outside world anymore, is it?
Precisely. And that's where eliminating intercompany transactions becomes absolutely critical for ongoing consolidation.
How much gets eliminated? Just the parent's share.
No, 100% of all intercompany transactions and their effects must be eliminated. Even if the parent only owns 80%, you eliminate 100% of the transaction between the parent and sub.
Why 100%?
Because from the consolidated perspective, the parent and subsidiary are viewed as a single entity. A transaction between them is like moving money from your left pocket to your right pocket. It didn't involve an outside party, so recognizing sales, profits, or payables, receivables from these internal transfers would distort the true financial picture of the consolidated group's dealings with the external world.
Makes sense. What are some common examples of these eliminations?
Let's hit a few key ones.
Okay.
Intercompany inventory transactions. If the parent sells inventory to the sub, or vice versa, especially at a profit, we need to eliminate that. The total amount of the intercompany sale and the related cost of goods sold must be removed from the consolidated income statement. Crucially, any profit from that sale that's still sitting in the inventory of the company that bought it, because they haven't sold it to an outsider yet, must also be eliminated.
So the inventory goes back to its original cost to the group.
Exactly. You defer that internal profit until the inventory is actually sold to an external customer. This prevents the group from recognizing profit prematurely just by shuffling goods internally.
Okay, inventory profits deferred. What else?
Intercompany sale of depreciable fixed assets. Similar idea. If the parent sells equipment to the sub for a gain, that gain is unrealized from the consolidated viewpoint until the sub eventually sells that equipment to an outsider. So we eliminate the intercompany gain. We also have to adjust the asset back to its original cost to the group and correct the depreciation expense.
Correct the depreciation. Why?
Because the purchasing company, say the sub, would start depreciating the asset based on the higher price it paid internally. From a consolidated view, that's too much depreciation. We need to adjust it back so depreciation is based on the asset's original cost when the group first acquired it.
Ah, okay, so eliminate the internal gain A and D, fix the inflated depreciation. Got it. Any others?
Intercompany bond holdings. If one company buys the bonds of another company within the group from an outsider, the debt is considered retired from a consolidated perspective. And you might recognize a gain or loss on that extinguishment in the consolidated income statement. Also, intercompany payables and receivables simply cancel each other out.
So what does this all mean in the end? Consolidated statements, they're really about presenting this unified picture.
Exactly. Consolidated statements effectively combine the financial figures of a parent and its controlled subsidiaries, meticulously eliminating all these internal intercompany transactions and their effects. The goal is to present the economic reality as if they were a single company, doing business only with external parties. It's the ultimate financial merger for reporting purposes.
And what do these finished consolidated financial statements actually show us?
Well, the consolidated balance sheet will include 100% of the parent's assets and liabilities, plus 100% of the subsidiary's assets and liabilities, all after those fair value adjustments and intercompany eliminations. But crucially, it does not include the subsidiary's separate equity accounts, stock, retained earnings, etc. Instead, you see the parent's equity and that separate line for non-controlling interest within the equity section.
Okay. And the income statement.
The consolidated statement of income includes 100% of the parent's revenues and expenses and 100% of the subsidiary's revenues and expenses from the date of acquisition onwards. It shows a single, combined, consolidated net income. Then, usually right below that, it will break out how much of that total net income is attributable to the non-controlling interest owners and how much is attributable to the owners of the parent company.
Fascinating. So you see the total pie and then who gets which slice.
Precisely.
Wow. We have truly taken a deep dive today. We journeyed all the way from the basic definitions of financial instruments.
The building blocks.
Right. Through the accounting for debt and equity based on intent and market value, navigated the nuances of influence with the equity method.
Capturing that economic relationship.
And finally, united entire corporate empires reporting-wise through consolidated financial statements. It's a complex world, but hopefully you, our listener, now have a much clearer map.
I think the core takeaway, if we had to boil it all down, is this. The level of ownership a company has, its intent for holding an investment, and the degree of influence or control it exercises. Those factors fundamentally dictate how that investment gets reported.
It's not just arbitrary rules.
Not at all. It transforms how gains and losses hit the income statement, or OCI, how assets are valued on the balance sheet, and ultimately whether two legally separate companies are presented as one unified financial picture. This isn't just accounting minutia. It's really the financial language that reveals a company's strategic relationships, its structure, and its true combined economic performance.
Understanding these layers, these different methods, really allows you to decode the story behind a company's financial statements, doesn't it?
Absolutely.
It's about seeing beyond just the raw numbers on the page to the strategic intent, the level of integration, the operational reality that the accounting is trying to reflect.
Well, yeah.
So here's a final provocative thought for you to mull over. The next time you see a news headline about a major acquisition, or maybe you're looking at a report and notice an investment line item labeled equity method investment, or see assets classified as available for sale. Pause for a second. Ask yourself, what level of control or influence or simple intent is driving that specific accounting choice? And what hidden insights might that choice reveal about the company's strategy, its risk exposure, and its interconnected corporate world?
It's like financial detective work.
It really is. It's a game of financial chess, and now you understand some of the key opening moves and strategies. And as always, remember that the deep dive is custom tailored to satisfy your unique curiosities. Keep those sources coming our way for future deep dives. We love digging into what you want to know about.